Lorraine, are you able to start the tape recorder?
I got it on.
Fantastic. Okay, great. Everyone, this is Lorraine Grossman. She's working with me today, one of my associates. I'd like to thank her for all her hard work today.
Hi, everyone.
And congratulations, you guys made it to the seminar. Today we'll be discussing individual retirement accounts. Now, there are two sure things in life, and I want you guys to get excited. Why are you going to get excited? There's an old saying, there are two things in life. What are we sure about in life, no matter what? Two things.
So we're going to die.
Death and taxes. You're absolutely right. Death and taxes. And let's look at those two items. There's death. Can't do anything about that yet. Maybe one day with technology going the way it is, maybe. But nothing we can do about death. Now let's look at taxes. Imagine something we can do about taxes, one of the sure things in life. What if there are ways to keep more money in your pocket? Would that be something of interest?
Yes.
Personally, I like holding on to my money. I'd like to think you guys would probably agree with that. So let's talk about that, and that's what we're talking about today. What is the single most important factor to growing your income? Anyone want to take a wild guess?
IRA.
IRAs help,
Investment.
but beyond that, a higher level. Investing helps, but it's not rate of return, it's none of that stuff. It's actually tax advantage. Tax advantage. Being able to defer taxes or accumulate your assets in a way that's going to be tax advantageous is the way to grow your assets beyond any other factor. So what are we going to be talking about today? Well, we have a huge agenda where you have a lot of information to get to, so I'm going to break it down for you. Number one, we're going to talk about deducting IRAs. Can you deduct? It used to be anybody and everybody could deduct, not so much the case now. Next, how are they taxed? How are IRAs taxed? How are the withdrawals taxed? And how is it going to affect you guys in retirement versus if you took it earlier than retirement? Next, we're going to talk about Roth IRAs. What's a Roth? What is a Roth? Why is it different? How is it different than other plans? And which is better for you, a traditional or a Roth IRA account? We're going to talk about the differences as well. Then we're going to talk about the investments contained within your IRA. Growth versus income. I cannot stress the important enough. To some people, they may think it's just a difference in semantics, but they're very different strategies. And then we have, should you do what's called a Roth conversion? Have you even heard of a Roth conversion? We'll explain what that is and whether it's advantageous to you guys as a whole. Now, there's actually another agenda, as I mentioned before. We want to talk about how the new tax bill has affected the IRA accounts. And we'll get into that on a very high level as well. Does that sound like a good plan? Okay, great. If anyone else has anything to add, write that down right now, and we can add that to your list of questions, and hopefully I can cover that at the end. So before we begin, I'd like you to turn all your cell phones off or on vibrate. If you're expecting a business call, I completely understand that. If you don't mind sitting to the sides, you can easily go out. If you need to take that call, I completely understand. Just I ask for a little bit of just common courtesy, professional courtesy. If you don't mind not eating, just refrain from eating. It's only an hour and a half based on questions. So I think you guys can handle that hour. Even if you're hypoglycemic, I think you should be good to go. And then if you don't mind, again, holding your questions to the end of the program. I've been doing this a long time. We do a lot of presentations, and 90% of the questions that are asked usually they're usually answered by the end of the program. So if you don't mind holding off and just writing your questions down, that would be very much appreciated. I appreciate the etiquette. So this wouldn't be America without a legal disclaimer. I am not your advisor. I don't represent you at this point in time. What we're discussing are general concepts based on my personal experience. If you want to find out the practice to the theory, then you're welcome to come meet with me. And let's talk about that for a second. I've dedicated, actually, it was originally 2 weeks, but we extended it. So actually it's the next 4 weeks, specifically to this group, and I'm doing another seminar, if you didn't already know, next week. So the next couple weeks are going to be dedicated for these two groups. If you want to see me, take advantage. It's a complimentary meeting. We're not obligated to discuss only things about your IRA. We can talk about anything under the sun financially related. So again, I encourage you to take advantage of the window of opportunity I am giving you completely free of charge. So with that, understand that I will be booking up very quickly. Generally speaking, mornings, early in the morning and later in the afternoons usually book up first. Of course, the people are usually taking off from work. So I encourage you to book now and book quickly. With that in mind, you might be struggling because you are at work. How are you going to make that happen? Maybe this is your lunch hour and that's why you're here midday. Again, it's just like taking a doctor's visit. Either you'll have to go into work a little later or leave a little early. Any questions about that? Okay, fantastic. All right, so you received a folder when you first entered the room. Those contain several things. Number one, pen to make any notes down. We have a map to the office. Hopefully that's there. If you don't have the map, then you understand literally we're 2 minutes away from this location. Our office is down the street on Torrance to the left at the Sun Breeze building. So I clocked it. It's 2 minutes. You'll have no problem finding it. And again, you could literally walk there in about 10, 20 minutes. So very close by. Hopefully the map won't be needed. But I will, again, make myself available for the next couple weeks. After that, I will be going back to my paying clients, managing their portfolios, and discussing their issues thereafter. So again, take advantage of the window of opportunity that has been provided. We have also provided a company brochure. That company brochure is going to give you background on the firm. We've been around since 1999. We have a very strong record of success. And I think you're going to appreciate some of the things we talked about when you decided to come and talk to me. We're going to provide a piece of scratch paper. You're welcome to use the back of whatever we've given you. It's really, I don't know how much people are going to actually recommend in terms of writing down, but you have the opportunity to jot down notes if you so feel fit. And then finally, we have what's called the feedback form. Yes, Lauren, you have a question?
Just a reminder that some of them might not have the calendar for May 7th to May 20th.
Yes, we actually ran low on calendar. So again, it's the next couple weeks. So go ahead, if you don't see the appropriate time, talk to Lorraine or I. We'll figure out a time that fits you in within my schedule, and we'll make it work. So we'll try to do our best in terms of having flexibility within the schedule. Finally, we have the feedback form. The feedback form is probably the most important factor, most important element in your folder we provided. Why is it important? Well, it's important to you, and it's important to me. It's important to me because we've been doing these seminars a very long time. And the reason we've done it with such a great efficiency and workflow is because we've gotten great feedback from the people who have attended these seminars. And it's important that we keep getting this feedback to know what you like, what you don't like, what we can improve, and make this the best possible seminar that we can. We want to make it very efficient and enjoyable for you guys. So that's why it's important for us. For you, it's going to give you the opportunity to make notes, give you the opportunity to give us feedback. If you want changes, these are not the only seminars we do. We do IRA presentations, Social Security presentations, R&D seminars. We'll talk about what those are in a minute. But again, to be the best presenter and have the best presentation we possibly can, it's important we get that feedback from all of you. So if you could do me a favor, we'll take a little break halfway through, a little over halfway through. If you could just jot down some notes, what you think, we really do appreciate that feedback. Okay, so a little bit about the firm. We've been around since '99. We have multiple locations. We have a location in Woodland Hills. We have one here in Torrance, just down the way. We are very different than other firms in a lot of ways. The biggest of which being, we take great pride in sitting down and educating people on investments. Unlike other advisors that shove you into a particular product that may or might not be right for you, we take pride in explaining our strategy and understanding where we are in today's economic climate. And with that, we move forward educating you on the different assets out there, the other opportunities if you decided to work with us. So again, very different strategy than most other advisors out there. And understand that there's a big difference between some of the financial types out there and who we are as a financial advisor. We're basically what's called a fiduciary. And if you didn't already know, the Obama administration started the fiduciary rule that's enforced by the Department of Labor. And that requires anyone working with retirement accounts be a fiduciary and act in the best interest of those clients and put the needs of their clients before their own. So there are financial professionals out there that don't adhere to that fiduciary strategy. We've adhered to that since before it was acquired by the Department of Labor. So it's important that you work with a fiduciary, whether it's me or somebody else, to guide you. Remember, we only usually retire once. You want to make sure you do it right. So make sure you work with me or someone else, a professional that knows what they're doing, that's been through this hundreds of times, if not thousands of times, that can guide you down the right path. One more thing I just want to mention briefly, and that's the radio show. We have a radio show on 8:70 a.m. at 4 o'clock on Saturdays. If you are unable to listen to that broadcast, we do have the podcast version on the internet available if you are technically inclined. So do feel free to check that out on our website. About me. So I can tell you a little bit about the fact, yes, I'm a fiduciary. My first job on Wall Street was in '94. I have a license in a variety of different aspects, from everything from real estate to insurance to my securities licenses. But what's most important is the fact I really am passionate about my job. Not just about this passion about making people money, having people grow their money, but saving lives. And I don't want to think I'm too grandeur of myself. I don't want to think my ego's getting too big. But what I love most, what I'm most passionate about, is the fact I can go and talk to someone, and through helping them financially, I save lives. I have people who have literally come into my office on the verge of, I wouldn't say suicide, but they've come close. They were near that point. I've dealt with people that were going through a divorce. I've dealt with people that were $90,000 in debt. That was a few months ago. And I've been able to help them in one small or big way in every situation that I've come across. So one of my potential clients, one of my clients called me the Mother Teresa of the finance world, because I do take pride in helping so many people, in some cases pro bono. So if you guys have issues, you have challenges due to issues in life, I'd love to be more than happy to come in and help you. I do love what I do because I'm helping people. So I hope that explains where I'm coming from. So let's jump right in. Where did IRAs, how did they come about? What is the history of IRAs? So back in '74, and judging by the age of the most people in here, I'm guessing a lot of you do remember the '70s, a great time. If you guys remember, there's a little company called Studebaker. And Studebaker was a car manufacturing company that eventually went out of business. And when it went out of business, you had a ton of employees that were left without a pension. They did not have sufficient money in the coffers to be able to compensate those employees that worked hard their entire lives, 30, 40 years, to help build that company. So Congress stepped in and came out with something called ERISA, the let me see if I get this right, the Employee Retirement Income Security Act of '74. Now, the purpose of ERISA was not to generate IRAs. It wasn't to create the IRAs. That was a byproduct. It was to ensure, incidentally, that pensions were well funded. It was a regulatory act. But by consequence, they came out with the IRA program. It did not require people at that time to have a pension, but if they had a pension, it required a certain amount of money allotted for those pensions. So as a byproduct, for those who didn't have those pensions, they wanted to give people an opportunity to save for their retirement. And that was where IRAs came from. Now originally they started at $1,500 is what you could allocate. And that slowly grew. And that change was something called IRTA Act, which came along in 1981. So it went from $1,500 to $2,000. Does anyone know what it is roughly now? It just went up. More, $5,500. $5,500. That's one of the changes in the tax bill that we're going to be discussing. So a lot of changes happened. Again, that sparked IRA. And as you see, over time, there's been a huge transfer of responsibility. Does anyone know what that responsibility is? It's been a shift of security. Once upon a time, companies were responsible for taking care of their employees. Now, whose responsibility is it? It's all you guys. Again, more than ever. That is why you need to talk to a tax professional, me or somebody else, that can walk you through this program, that knows what they're doing, that's helped hundreds, if not thousands of people. So, let's talk about an example. Is anyone here a science fiction fan? I'm a big geek. I love science fiction. And in science fiction, you have something like a parallel universe, right? Where what's reality here may be reality for something else. So let's pretend we have two different realities. This is your reality where you were smart enough to put your money in a tax shelter plan. Let's say an IRA or 401k. Let's say an IRA, right? Just a traditional IRA. Versus another example where in a parallel universe, you were able to put that money away in just a regular old account, right? A taxable brokerage account. Maybe you open a Schwab account or JP Morgan, whatever. So in the first example, in our current reality, if you will, let's say you put $2,000 away for a 40-year period, right? Then you multiply that by 8%. We get 8% because roughly if you ask someone on Wall Street, they're going to tell you 7 to 8% realistically is what you're going to get in terms of a return, a capital appreciation on your investment. After 40 years, you'll have roughly just under $600,000, right? Everyone with me so far, okay? I try to go extra slow with math so everyone's crystal clear on this. Then you're going to multiply that with what's called the 4% cash rule. Now the cash rule, going to a 4% mark, a benchmark, that's making a pretty big assumption. That is assuming that that 4% means you've calibrated the investments within your portfolio appropriately. A very, very big assumption based on the portfolios I see come across my desk. Now, having done this, I don't know, for years, I'd say roughly 95% of the portfolios are not appropriately calibrated for retirement, right? There are two different strategies. We'll go over those strategies a little later. But you must be calibrated properly with that to get that 4%, which is crucial. Because when you calibrate properly, you're going to get roughly off just under $600,000 an income of $22,000 used to replace the income from your job once you retire. Is everyone clear on that? Again, you can generate off that 600 or just under the 600, 22 grand without having to worry about going back to work in your retirement years. Now conversely, in the other parallel universe, you have that same $2,000 you put away, which is roughly $1,400 after taxes, with over a 40-year period at 8% return, with a 4% cash rule, again, a big assumption, you're looking at only $8,200 that you're going to be able to exist on with that same amount of money allocated. So again, a huge advantage being able to tax defer. So let's talk about the types of IRAs. Now, before I even get into the types, let's talk about what an IRA is. I talked to a handful of people that had no clue. They thought that IRA was itself an asset. That's incorrect. An IRA is an individual retirement account, as it says. It is an account. Imagine, if you will, a box. So here you have the box. And in this box, you have assets that go in the box, right? So those assets can be anything from stocks, bonds, even real estate, which we don't recommend, gold, silver, you name it, precious metals. When people see they're not performing, their IRA is not performing, it's based on one of two things, either fees that surround that box, or maybe layers of fees in particular cases, or the assets within the box are not performing or calibrated appropriately. Or they are bound to the market in such a way that you're taking a huge amount of loss in certain times when the market goes down. So it's important to understand there's several issues. That's probably the number one question that I get when people come into my office and show me another portfolio. They say, why is my portfolio not performing? And that's exactly why, one of those two reasons. So let's talk about the different types now. There are several different types, right? And I'll try to break it down so it's very simple. So on a very high level, there is Roth and everything else. So what is everything else? Just throwing it out there, you have things like traditionals, you have 401ks, you have simples, you have SEPs, you have 403bs, you have 457s, and so on. You have Kios, we're going to see Kios in a while. I had a client come in with a Kio, and I felt like I saw an old friend I haven't seen in ages, because it's been such a long time since I've seen a Kio plan. But when you break it into two different sections, again, there's Roth and everything else. What is the big difference? With a traditional IRA, a 401k, and so on, you're letting the amount, your principal, grow over time. And you'll see very quickly that the IRS see things very differently than we see things, right? To us, it's our hard-earned money. We work slave for it, worked overtime in some cases, and we want to let it grow, and then we want to retire and live off that income. But to the IRS, it's something very different. The IRS says, well, you see it as your hard work, but no, we see it as something else. We see it as a loan. Did you guys know that you have a loan from the government? For those of you that like living debt-free? Surprise. It just so happens that they see it as a loan. And when someone gives you a loan, you eventually have to pay it back, right? You have to pay the piper. So at that point, there comes a point where at a certain age, you have to start taking money out. And that's called RMDs. We'll talk about that in a second. So what happens is the IRS lets the money grow tax deferred, right? And then at some point, you have to pay the piper, And you have to start taking that money out so they're able to tax you on it. So we'll talk about the RMDs in a second. But any kind of withdrawals made prior to 59 and a half, and I'm guessing based on the ages of most of you that isn't an issue, but before 59 and a half, there's a 10% penalty for early withdrawal. Other than that, you have to start making withdrawals at that particular age that I mentioned. So you have that within the categories. Then you have Roths, right? Then within the Roth, you have a point where you've taken this money and you've already been taxed on it, right? So the government says, no harm, no foul, we're done here. And you're able to draw or grow the interest and the dividends completely tax-free thereafter. Sound pretty good, huh? So the reason that the government does that, in some cases they may need the money now versus later. They like the fact they can take that money now and they can tax you on it. So the interest and dividends, again, are tax-free with a Roth. Finally, we have something called SEPs and Simples. We're not going to get too much into that. That is based, those are plans made for people who are self-employed. And if you guys happen to fall in that category, come talk to me, bless you. I can go ahead and talk to you on a one-on-one basis. We can discuss the details of that later on. But the benefit of going with something like a SEP or a Simple, it's just simply higher thresholds. So what are the income contribution limits? Well, let's take a look. So the maximum contribution is $5,500 if you're under age 50. If you're over age 50, then you're looking at $6,500. We give you $1,000 to catch up. It's a catch-up plan. The compensation, and here's the caveat to all this, is the income must come from sweat of the brow. It must come from hard-earned work, whether it's your job or even alimony, right? It has to come, it cannot come from Social Security, it can't come from interest and dividends. And as I mentioned before, 70 and a half is a big age. So that's when you cannot contribute after the age of 70 and a half. And again, this only applies to the traditional. Roths are a very different story. So let's look at some of these thresholds. So if you happen to be covered by a retirement plan, so you have 401k, and you also want to start your own personal traditional, right? Then you're looking at these kind of thresholds. It's going to be based on income levels. So if you're single or head of household, and you make $63,000 or less, you're able to qualify for that amount, right? $5,500 or $6,500. Or if you're married and they don't have a plan, then it's double that. So 11 or 13, right? So if you're within the range of 63 to 73, it's a sliding scale. It's a partial deduction. And then if you make over 73, you simply can't do it, right? Again, this is not made to tax shelter in the eyes of the IRS. This is done to plan for your retirement. And that's exactly what the IRS has done. They put these protocols in place to make sure you're not trying to stash money away that they want to get a hold of. If you're married filing jointly, $101,000 or less, you can do the full deductible. If you're over $101,000 within the sliding scale of $121,000, a partial deduction. And then over $121,000 or more, no deduction. And then if you're married filing separately, less than $10,000, you get the partial, otherwise you can't deduct. Now, if you're not covered by a retirement plan, what does that entail? Similar situation, but it's any amount if you're single, head of household, married filing jointly, any amount. And if you're married filing jointly with or covered by a plan of work, you're looking at 186 or less, or a sliding scale between 189 and 199, that's the partial deduction. And then you have 199 and more, you simply can't do it. And then again, married filing separately, they have the most strict protocols there, less than 10,000, a partial deduction, or you can't do it. So let's talk about, before we can talk even more about the IRAs, we have to address how our tax system works. For those who didn't know, we are on a progressive taxation system. Unlike other countries, if you make, let's say, $100,000, all $100,000 is not taxed under the 28% bracket. Meaning, if you make $100,000 in income, the first $9,325 will be taxed at a 10% bracket. The next chunk of money, $9,037,000, will be at 50% and so on. So it's a very progressive tax system, and that's a good thing, because you're not taxed, it's actually enabling you to be taxed less rather than taxed over a higher amount. So within this bracket, if you're making, let's say, 130, 140, you're basically looking at 100 in terms of what you're going to be taxed on, right? Does that make sense? So when people say, I've had someone come to me and say, oh, I'm in the 18.8% tax bracket. There's no such thing as an 18% tax bracket. That's a combination. What they think they were referring to was your marginal, which is really your top taxation bracket. So to be aware of that, that's what we're referring to when we're looking about thresholds in the last slide. This is what's going to apply. Now, a lot of you may be thinking, well, I can figure this out. This isn't rocket science. Why would I need to talk to Alec? Well, you need to talk to Alec because this is only the icing on the cake. This is just the tip of the iceberg here. Because while we're talking about income, what we're not taking into account are challenges that come up when you start drawing income from your IRA. Because that's going to be affected. How is that affected? Does anyone know? Does anyone know, during the Great Depression, what president started Social Security? Very good, FDR. And do you know what his pledge to the American people was? This is the biggest controversy when they first started it. First of all, they didn't think it was work. There are always going to be naysayers. They didn't think it would work. But what was the other big thing they said? What was his big pledge to the American people? He said, it will not be taxed. And guess what happened in the 1980s? It was taxed. And guess what happened again in the 1990s? It was taxed again. It went from a 50 to 85% potential bracket. So, with that in mind, what people aren't usually prepared for when they hit retirement is if they're still working or they're drawing from IRAs, and then they're getting income as well from the Social Security, that could affect you. Maybe bumped up in a certain bracket and be taxed even higher. Another reason to have a strategy to fight that, to be able to anticipate that, and talk to someone who knows what they're doing. So, we talked before about RMDs. What are RMDs? They're the time when you got to pay the piper. It's when the government comes knocking on your door and forces you to start taking money out, starting at roughly 3.65%, and every year it goes to 3.7, 3.8, 3.9, and so on. And what's good here is they actually give you the opportunity to take it out in slow amounts, not one large lump sum, right? But when you take it out, it is taxed, if you're a traditional or 401k, as ordinary income. Very different than if you're with a Roth. So with that in mind, you have the opportunity. Usually you're required to take those RMDs out by December 31st, whatever the balance is, December 31st, of your account, right? And you basically have to file that on your taxes. The first year, when you turn 70 and a half, you do have the opportunity, you have the choice to either do it that first year or wait a second year. So the question remains, do you take 2 hits in the second year, or you do it evenly throughout the years? Another strategy you have to consider, depending on how much you're making, depending on whether you're retired, depending on where you are in which tax bracket. So how do you figure out these RMDs? What is the formula? Quite simply, there's a table, right? The government doesn't make anything easy. They have something called Publication 509. And with the publication, it looks a little like this. Not that you can really see the numbers, but you can Google it and see what it is in detail. So they take your expected age, and basically you take what your balance is on your IRAs, December 31st of that particular year. And then you're going to be divided by what's called the factor, and that's going to give you your RMDs. That factor is based on your expected lifespan. And ironically, I don't know many, for example, 73-year-olds that live another 27 years. But again, they're being generous and giving you the opportunity to spread it out over time. So with this uniform lifetime table, you get an opportunity to break it down. There is a different formula, a different table, if your spouse is over 10 years difference. So again, just understand if you're married and you have a spouse that is older or younger than 10 years, just understand there is a different table there. So let's switch gears and talk about Roths. There's Roths again and everything else. Why are Roths different? Well, we talked about the fact that you're taxed up front and then the interest and the dividends grow. The question is now out there. Is it better to be taxed on the chicken or the egg? The chicken or the egg, right? Well, the answer is it depends. There's no right or wrong answer, and because we're a big group of people here, it's going to depend on your particular situation. Another reason to come talk to me. But what are the thresholds like? Well, it's similar to traditional. I get $5,500 for the maximum contribution, the $1,000 extra bonus if you're over 50. Must be earned income yet again, and taxable alimony is allowed. What's the best thing on this slide right now? There's no age limit. You don't have to stop at age 70 and a half. So even if you had a traditional IRA, right, even if you were still working, let's say you want to still stash the money away, you can still have a Roth IRA.
Is alimony still under the new tax?
Yes.
It's still under?
Yes, it is. And we'll be addressing that later. So again, with Roth IRA contribution limits, kind of similar. You have 189 if you're married filing jointly, 189 to 199 you get the reduced, and then you just can't do it if it's over 199. Married filing separately, under 10,000 you're reduced. You have that sliding scale. 10,000 is 0. And then for single-headed household, it's 120 up to the limit, and 120 to 135 you get the reduced. You just can't do it if it's above 135. Okay, so we talked before, these are personal plans, right? Now let's talk about employee-sponsored plans. Those are the 401ks. Those are the 403Bs and the 457s. Why do we like them? Higher thresholds. You can throw in, you can stash more money in these retirement accounts. In some cases, it just went up. It used to be 18, now it's 18.5 if you're under age 50. It's 24.5 if you're over age 50. Now the question's now out there, do I contribute more to my work retirement plan or my personal retirement, my Roth or my traditional IRA plan? Well, as a rule of thumb, it's better to go with the work because of the higher thresholds and because you usually have a match. And if you write nothing else down today, this is the most important thing I say all day. Are you ready? Anytime someone gives you free money, take the free money. Biggest rule, right? So, yes, you want to take advantage of the match, in which case most employers, some employers, let's say you make, you have a 3% match, you put 3% in, they'll do 3%. So that's 6%, you've automated the process and you're saving in this account, which again, you're growing tax deferred. Very advantageous. So, next we're going to talk about stretch IRAs. And the big confusion here is there's no such thing as a stretch IRA as its own product. A stretch IRA is a strategy, not a product. It's the ability to take $100,000 in a retirement account and have it grow to $1 million over the course of several lifetimes. You're able to pass down this generation using certain strategies to have it grow. Right? And that, in just a particular example I'm thinking of, you know, if, for example, you were to pass on $100,000 in your IRA to a child, he lets that grow, he takes the minimums, the required minimums over a period of time, a little over the years, but it's still growing overall. In which case he's still able to translate, let's say he can transfer that to his spouse. And over the course of a lifetime, 40, 50 years, maybe even 60 years, you grow that 100 potentially to $1 million, depending on what the market does. So again, that's a strategy you need to discuss with a tax professional, preferably me. But